Well, hello everybody and welcome to this episode of the ESG and Tech Show. My name is Susan Hayes Cullerton and I am delighted to be here today to talk to you all about what the top tech capitals of the world have taught us and of course what they continue to teach us as we are in this very different phase of the stock market this year. So, as always, I would love to know where you're tuning in from, so let's take it from the top and let's first of all hear, and I've got my chat here open right here beside me, let's just hear where you're tuning in from. Now, as we're doing that, I just want to let you know a little bit about why we have this show and what my purpose is, particularly in leading this for VectorVest right here on YouTube. So, first and foremost, what we're here to do is talk about the two biggest mega trends of this particular decade. That is what we are here to talk about and to discuss, is what is it that is underpinning what is happening right now in the market and indeed in, as I say, these two mega trends. So that's why we love to hear from people all over the world and in this interactive conversation as well. So like I say, please do, I'm just checking here to see where people are tuning in from, so please do pop it into the chat and let us know exactly where you are tuning in from so that we get a sense of where people are tuning in from right around the world. The second reason that we talk about this area is that technology is something that is creating so much change in how we spend our money, in terms of how we interact with different companies, in the expectations we have for customer service, how we decide where we're going to travel, who we're going to interact with, how we're going to do that, how we communicate, where we decide to work, etc. So technology is something that is really having a big impact right across our lifestyles and how we interact with those that we care most about, as well as those who have the greatest influence in our lives. So again, for that reason, it's really important to look at technology and then see, okay, how do we weave this into the stock market and where we decide to put our money so that then, as the saying goes, we are not where the hockey puck is, but instead where it's going to be. So, again, just want to welcome all of the new people that have just joined us there a moment ago. I see our numbers have gone way up there in the last couple of moments. So again, please do let us know where you are tuning in from what part of the world, what city are you in, what state are you in, what country are you in. It's always intriguing for me to find out exactly where our audience is comprised of. And while you're doing that, because I'm keeping a very close eye, while you're doing that, I also want to tell you why we are looking at ESG as well. Why is it that we look at the environmental, social and governance aspect of investing? Is because it is gaining more and more traction across all demographics, but particularly of the younger demographics. And of course, we know that while the money that is being invested on the part of whether it's Gen Z or younger millennials is relatively small at the moment, that is going to grow and have a greater influence. But also look at the new products that are being created. Look at the new ETFs that are coming on board. Look at the new metrics that are happening. This is also shaping the way in which we make decisions. And I feel, as a member of the VectorVest team, that it's important that you, our audience, are well equipped to deal with both from the technology point of view and the ESG point of view, so that you can make better decisions more in line with you and your values when it comes to investing. Right, so I now see that we have lots and lots of people who are tuning in from all sorts of places. Right, let me take it from the top. We've got Austin, Texas. Hello, Mohammed. Hello, indeed, from Missouri. Dee says, well, hello, indeed. Dee, would you believe I subscribe to a gym in Missouri? It's a virtual, well, it's not a virtual gym. It's a real gym that I subscribe to virtually. So that's my only interaction with there so far. Hello, Eric, who's joining us from the Smoky Mountains. Eric, I don't know, is it the first time you've been on this show, but I don't think I've had someone from the Smoky Mountains before. Hello, QA is joining us from Madrid in Spain, fabulous part of the world. Hello, Prakash, joining us from Calgary in Canada. Liliana is joining us from Montreal. Dirk is joining us from Belgium. Hello, Dirk. Your name, of course, is very familiar. You're regularly on our VectorVest Europe webinars. Hello, Mark is joining us from VectorVest in Brooklyn, New York City, of course, the city that I know and love and have been there many times. Hello to Focus from Dallas, VK from Ohio, Osman from Fort Lauderdale, Frank from Tucson, Arizona, Frank from Genk in Belgium. Had never actually made it that far. Been to Ghent, of course, but never quite that far. Richard from Montreal. Cheryl from Cleveland. Cheryl, I was only in Cleveland 3 weeks ago. Beautiful part of the world. Florida, and how does the QT impact the market tomorrow? Definitely we're going to talk about the Fed today. Dee says, Jens, get fit. Okay. Ryan says, Boston, Massachusetts. Kenny is here from Nashville. Daniel is here from New York City. Lee is from here, from Winnipeg in Canada. Okay, keep them coming. That's really, really great to see here. Hello, Dinesh is joining us from the UK. Where in the UK, Dinesh? Again, part of the world I know pretty well. And, I always kind of have this mini competition with myself to see how many parts of your cities, how many parts of the world have I been to when I'm hearing from you. So again today, it's wonderful to see we've got a completely wide interaction there across the board with lots and lots of you, and it's always great to have you. Okay, so let's talk about where we're going to go with today, right? So part of me was, when I was getting ready to prepare for today's show, part of me was I was going to go to going to do some research into the top the top tech cities of the world, and I was going to extrapolate what exactly is it that we can learn from the top tech cities of the world. Where is tech going? Where are the new cities, and where's the new companies coming out of from an IPO point of view, etc., so that we can see where to go in the future. However, the reality is that I'm actually in a different scenario entirely, as are you, because of course technology has really taken a nosedive over the past year and even in the past month, but particularly since Jackson Hole last Friday. Not just tech, but generally speaking, the market. Last Friday, I was sitting at home watching the TV, and it was just coming up to the market close in the US. So in Dublin, that was like coming up to 9 o'clock, and the statistic was that day, 99% of the S&P 500, in terms of the number of stocks, had fallen. And then I was thinking, okay, right, now what are we going to do about this? And then, of course, I popped on over to have a look at my VectorVest screen, and then I could see that we had indeed been triggered into a confirmed down call. So, right, I said, right, the first thing I need to do is talk to you about that, right? And I think it is important that we look at the overall market, and before we get into the tech capitals and what we can understand, let's take a look at the overall market, and let's see what's going on, and then let's see, how we can make sense of what is going on. And that pretty much, to take into account here, Police SWAT from Florida, who says, how does the Fed QT impact the market tomorrow? Let's have a discussion around that. But, of course, I also want to stay true to our topic today, which are the tech capitals. And what is it that we have seen? Well, the thing is that when we do look at the tech capitals, and like, there's loads and loads of let me just show you this here now for a moment. There are loads and, sorry, that's not where I wanted you to go, and instead it is here. So as you can see here, we have loads and loads and loads of top tech cities, right? And also I have lots of different tables where you can see that. So here you can see San Francisco, New York, London, Boston, Austin, Chicago, Paris, LA, Seattle, Toronto, right? And here we've got our top 10 tech cities, and particularly how this table determines that they are what they are is because it's based on the number of startups per 100,000 of the population, right? So here you can see we've got 2,200. I'm just going to bring it down here. There you go. So according to our database in San Fran, total population is only 865,000. Again, city that I really like, been there a good number of times, beautiful place. And there's 198 startups per 100,000 people and 258 high-tech companies per 100,000 of the population. That is how it's determining who the top 10 tech cities are. Now, the question is though, when it comes to where technology is at the moment, sectorally, of course, a lot of that is going down. So is there a correlation actually between what is going on in these top 10 tech cities that is actually causing the market pain at the moment? And the answer is yes. Yes, there is. And that is what I wanted to talk to you about today, is that I just want to see what is it that has changed in the market. What is it that has actually changed today and changed the way we're doing things, changed the way investors have looked at things? What is it that is today different? And as a result of what's different, what can we learn about it? And most importantly, what can we do about it as well? Now, I'm Dinesh says near Gatwick Airport, near Crawley. I know it indeed, Dinesh. Thank you for being here. And Dee says, Jen's is the #1 Missouri virtual gym. Thought that was who I was subscribed to. It's actually the studio, Dee. Also as well, I can see Andy is joining us from Dallas, Texas. Oh, you're very, very welcome. Been to Austin, been to San Antonio, must make it to Dallas next. And Kenny says supply chain. Now, let's look at all of that, Kenny, and let's take into consideration what the Fed is talking about, and supply chain, and inflation, and all of the other things that we need to discuss today. But first of all, we need to start here. Look at this. Look at these red lights. Okay, these are really, really red. These are really, really red lights. Now let me just attach this. I'm going to try and make it slightly bigger here for you. Okay, hopefully that is easier. And please do keep your comments, keep your questions coming in, and also feel free, if you want to comment on someone else's comment, please do. The chat is there to chat, not just with me, but among yourselves as well. I'm keeping a good eye here. It's always great to see people interact with each other. So, please do keep them coming. Right, last Friday was Jackson Hole. And last Friday, what happened was the Fed announced, okay, here is what's going to happen. Right now, inflation is really high, right? And I can say that whether you're in Europe, I can say that whether you're in China, I can say that whether you're in the US, I can say that whether you're in Ireland, I can say that whether you're in the UK, whether you're in Belgium. So what do we do about that? And you see, this is the challenge, right? This is the challenge, is what can we do about that? Picking up there on Kenny's point. Kenny's point says it's a supply chain issue, okay? So inflation is high because, for a start, there is a constraint on energy. It's difficult and expensive now to find energy. Many of us know why that, of course, might be, and that is because, of course, there's a war in Europe going on, and of course there is a big, there's a crisis going on in actually obtaining energy. Energy has increased dramatically, has increased in price, and there has been a huge amount of focus on green energy over the past decade. But of course, in order to transition really and truly at massive scale away from fossil fuels, etc., we do need the continuation of oil and gas. Now, in order to get us there. Now, I was looking into this solely, just looking into this last week for Ireland. Now, Ireland is a small island in the middle of, not the middle of the Atlantic, but it's, in this, as you look at the globe, when I look at the globe living here in Europe, I'm looking at, the US is on my left, Asia is on my right, and we're in the middle. A small island that's there. 5% of our energy in 2005 came from green sources. At this stage, it's 12, but it's only 12. And that is, of course, very significant. And when we look at electricity, the rate is a lot higher. But when we look at when we look at heat, for example, Ireland uses quite limited amount of green energy in order to power heat. So we still need oil and gas. And also, of course, as we mentioned, there is a big issue there. So the thing is that what can you do if you're at Jackson Hole last Friday? What can you do about that if you are a central bank? If you are the Bank of England, if you are the ECB, what do you do? What do you do? Well, the thing is that, what have you got to do? You have got a portfolio of tools. And this is coming back there on Police Watt's comment. When you have got a portfolio of tools, are any of them, the question you would need to ask, going to affect inflation? Well, let's think about it, right? So number one I can do is I can change interest rates, okay? So, and interest rates have indeed been increased. They've been increased in Europe, they've been increased in China, in the US, they've been increased in the UK. We've seen increases in interest rates. But what does that do? What does that do? And let's just bear in mind, we have four red lights here. What does that do? Well, what an increase in interest rate does, and Richard, I want to come back to you on your point. What increase in interest rates does is, number one, is that it makes loans more expensive. For a start, borrowing. It makes borrowing more expensive. So if I am, as a company, I want to expand my operations and I want to double my workforce or increase my workforce by 10%, and I need to borrow to do it, it's now more expensive. And the idea is that it kind of tames down activity like that. And therefore I think, I'm not really sure if now is the time, or, now I need to be really sure that this growth is going to happen, or I can't, it's now more expensive to take bigger bets, if you want to call it that. Right, so that's what it's designed to do, is kind of tame that type of thing down. Second thing is, if it makes loans more expensive, of course the natural one and the consumer one to pick up on here is consumers. So therefore, if I'm borrowing money for a house, whether it's a bigger house, my first house, an expansion, etc., well, now of course my mortgage has now gotten more expensive. Now, we all know that consumers don't just stop there, and businesses don't just stop there, because if I am considering getting a mortgage, I'm not just thinking about, well, Jackson Hole this time. I'm not just thinking about the 8th of September and based on investors are factoring in, they're pricing in a 50 basis points increase in interest rates. That's 0.5% increase in interest rates in Europe. I'm not just thinking about that. I'm thinking about, and then what? And how much more could I actually handle before I get to a point of thinking, that could put me under pressure. And if I'm thinking that way, then I'm thinking, okay, either I shouldn't borrow as much, or of course, not borrow at all. That is what the central bank ultimately wants, is that, again, taming things down. And why do they want to tame things down? Because, of course, if either both of those parties, the company and the consumer, is not borrowing to expand or borrow or buy or whatever, well then, of course, then that keeps a lid on inflation. The problem is, ladies and gentlemen, what has any of that got to do with what I was just telling you about oil and gas? Nothing. And here is the central bank's problem, is that the tools they have to deal with inflation are actually not the tools that are getting at the root of the issue. But if you were a central banker today, would you leave inflation at 8, 9, 10% and do nothing? Well, you couldn't, because of course the Fed has just two jobs: maintain full employment, if it can, up to full employment, and keep inflation at or below 2%. And independent of how likely your tools are to work, if you don't use them at all, well then you're not doing your job. And that is why we are seeing such of those red lights there in the market at the moment, is because the market is saying, right, increasing interest rates. And at last week at Jackson Hole, they kind of said, we're not done and we're not going to stop doing what we're doing, namely increasing interest rates. So that is having the effect then. It is having the effect on borrowing. It is, of course, having an effect on mortgage borrowing and so on like that from a sentiment point of view. But now, let's do a little twirl here. And I was just listening, I was telling Joy about this. Joy, as you know, first of all, isn't Joy amazing? Can we all just say hello to Joy? Would you all mind just telling Joy that he's brilliant? If you don't mind, in the chat, because you know what? You never see him, and yet I always say it's important to thank people who make things go well, but it's equally as important to thank people who prevent things from going wrong. And Joy's the guy that always makes sure things don't go wrong. So just want to say hello to him. And he always loves the comments, so you might just give him one. I was briefly having a chat. Joy asked me earlier on today, when were we going to do our tech check? And I said, I'm just listening to the end of a Market Watch podcast. It's done on a daily basis, and I was listening to it anyway. And it was just kind of presenting the real conundrum that's in the markets today, which is, at the moment, we are at record highs in terms of job openings, right? Employment, yes, but actually job openings. The number of jobs available continues to rise. So that's healthy for an economy, isn't it? Well, the thing is that, yes, as long as A, there's people to fill the jobs, and B, that jobs are being offered to people who want them, whereby you've got a market clearing wage. And this is another issue, is that, of course, within an inflationary environment, well, now there's a lot of pressure on companies to pay higher wages. Now you might say, okay, isn't that a good thing? Yes, if you're the employee seeking and likely to get the wage increase. But can I also put this to you, is that there's a couple of other knock-on effects here. Number one is that if I'm doing business with you, right, any one of you, and you're paying your staff's wages, you're paying higher wages, it's likely that you can't just absorb that. You just can't absorb that without any impact for me. The likelihood is that you'll push up my prices as well. So if you push up prices, if you push up wages, well then that will actually create its own perpetuating cycle of inflation as well. Okay? And you might say, look, yeah, right, necessary, but there you go. Okay, fair enough. But now let's continue the chain. Is that also, if we're looking from the point of view of where my own respective supply chain is getting more expensive, whether that's my suppliers and or my staff or both, well now what I need to do is I need to think about this from the point of view of I'm also now going to have to pass on those prices to my own customers. So again, inflation continues. But we also now need to look at this from another point of view, is that if you give people more money by virtue of higher wages, that translates into higher purchasing power. If prices are stagnant, and of course we know they're not, right? Prices are not at all stagnant. But what that means then is that then you're in a position where people now have got more money that they're earning, and therefore they can lock in inflation. So if there is higher demand for rent, for example, if there's higher rent prices, then people have got the money to pay for them. And again, this is, of course, it's really hard to talk about this from the point of view of, well, what's the right answer? And if you look at this from an economic perspective or a political perspective or a social perspective, and of course the other one is that if prices rise and if we are increasing wages to enable people to be able to afford those price rises, well, then we also need to make sure that our social security net follows suit, or else you're going to massively widening inequality as well. Therefore, back to Jackson Hole. What can you do then about all of this? Well, they're doing what they're doing, which is increasing rates. And it looks like that is going to continue. So what does that mean for the stock market? Well, what it means for the stock market is, for those companies in the stock market, what they're now looking at is higher costs of borrowing from the point of view of debt. And also, it may eat into their profits. Okay, a lot of companies have got good, solid profits anyway. And of course, then they're also going to have to pay more for their staff's wages. Okay, fair enough. But there is one other element in here that we need to look at as investors, but from an alternative point of view. And that is, if interest rates increase, generally what happens is that bond rates and savings rates go up. So now the opportunity to make risk-free returns increase. Because if I can now lend to the US government, or I can lend to the UK government, I can lend to the German government, I can lend to the Japanese government at higher interest rates, risk-free, because they are utterly, they're posed to be default-free. Well, then maybe I would be less inclined to invest in the stock market and put my money elsewhere. So as you can see, the stock market is being attacked then from a number of different areas. And unless you understand those, it's kind of hard to figure out, well, what the hell is going on in 2022? So now let's just take a look here at what all of you are telling me as a result of this. You are saying consumers continue to buy like crazy, always at higher prices. Yeah, Richard, I suppose the thing is that consumerism isn't just driven by, well, how much can I afford to spend, but also, like, what do I need to spend? This month, well, tomorrow was always the day, I considered it anyway, is back to school. Lots of people have no choice but to spend on, and big money too, on going back to school, whether it's books or uniforms or stationery, etc. Obviously, we all know the festive season is a couple of weeks away at this stage. So, people often spend because they either have to or are encouraged to, etc. And even at crazy higher prices, it's people do need to spend, and of course then there's also the want to spend as well. And then we also have the influence of credit. I do want to mention one point though, and it ties back to the energy issue that I brought up a while ago, is on that Market Watch podcast I was listening to literally seconds before we went live here today. 20 million people in America are behind in their utility bills. That, Richard, that is not a nice to have, that is a need to have. And of course we are, those of us on the northern hemisphere anyway, are moving into progressively colder weather. So 20 million people is a lot of people. Now, Police SWAT says, just afraid the market may drop in September or the S&P 500 to 3,000 because of QT. Now, what's QT? Okay. Now, QT is the opposite of QE, and we've been hearing about QE since around about 2008. QT is quantitative tightening. Now, we haven't seen this. I have written an economics textbook twice. I have written an economics textbook here in Ireland for high school students studying economics. Never did we mention quantitative tightening because it was never taught like that. The idea of quantitative tightening just didn't exist. Well, it didn't. It just wasn't a thing that you discussed, really. And also, back when I was in college, my degree is financial maths and economics, right? That's where my degree was, and I went on to study Chartered Financial Analyst Charter Holder. I'm a CFA Charter Holder now. When you put those two together, we first of all heard about quantitative easing in Japan in the 80s as a last chance saloon sort of a thing. QT wasn't on the agenda. So what is it today? So let me explain what QE is, and then I'll talk to you about what reversing that is. QE is quantitative easing. It is where the central bank prints money and then buys up bonds. So then it basically lends that money to a government and therefore indirectly reduces its cost of borrowing, but also actually creates money, then new money that goes into the system. Easing. It's easing into the monetary system. Tightening is the opposite. So this is where they sell their bonds and basically destroy the money. So they take money out of the system. And by taking money out of the system, of course, the idea then is that you're taking the heat out of the system as well. So that's what QT is. Now, will the market drop in September? I can't tell you whether it'll drop in September or not. But certainly, based on looking at this, I wouldn't be in a long position in the US market. I'm not in a long position, any of my positions at the moment. They're all closed because we're in a confirmed down. And a pretty significant one as well. So let's just take a tour of the market timing at the moment. Let's just take a look at, let's have a deep dive over here on our timing. Okay, so what I'm going to do is I'm going to take a look here at the graph first of all. Okay, here we have got a graph, and right now, so you can see here, this has been the market timing. I'm going to bring this up to year to date. There we are. Okay, so as we can see, basically the market peaked at the beginning of the year and then has been in a decline since. So when we look at the VectorVest composite here, we can see that the high price was at 68. We're now down as far as 55, right? So obviously the market has been in a pretty significant downturn throughout the year. And then we were actually having, ironically, a pretty good summer. Now you might say, well, what's ironic about that? Well, what's ironic about that is an old adage in the stock market is sell in May and go away. And that's often because people are gone out of the office. Traders have left the building, and therefore you don't have that volume and liquidity when they're there, particularly this year, since so many people had a lot of time off that they had banked and were now using up due to what's been going on over the last couple of years. So we've had a lovely summer, and then this whole inflation thing is not going away. So then we've been seeing this since then. So in essence, if I was a conservative investor, what would I be doing right now? I'd be looking at my confirmed calls, and I would be seeing that we got a confirmed down last Friday, and therefore that is the most conservative bearish signal that we can get. In other words, this is the last one. Anything after this, VectorVest doesn't even notify people about, because this is the most conservative call, but it's also of a bearish nature. The confirmed up call was given back here. This was back on the 29th of July. And before that, we were basically in a confirmed down call since the 12th of April. And before that, I'd have to go to scroll back there. But anyway, that's where we're at. If I'm going to go a little bit less conservative, and instead now what I'm going to do is I'm going to look at our MTI, our market timing indicator. Very simple to understand. Above one is favourable, below one is unfavourable. So when I look at that, I can see here that we crossed over one on the 29th, which was Monday. I can also see over here that we crossed over one on the 27th of July. So generally does tend to be a little bit earlier. I can see here that we crossed over one on the 5th of April. Yeah, 5th of April, we went down into 0.99. So you can see here again, generally the MTI is a little bit faster than the confirmed call. So you would have been out here, whereas the confirmed call took another couple of days. And that is because the confirmed call is that little bit more, it is that little bit more, what's the word I'm looking for? Conservative. Same one I've been using all along. Now, what if I am not a conservative sort of lady? And what if I am instead that I am more of a trader? Well, that is simple to do then, because what I'm now going to do is take a look at the colour guard. And the colour guard is going to give me all I need to know. There we go. The colour guard is going to tell me all I need to know. Now, right now, the colour guard is pretty clear as regards what's going on. Red is bad. Bad if I'm a long only investor. Now, if I'm short, Or if I am a put options buyer, it's a different story, of course. But if I'm somebody that was buying stocks, it's saying no, Susan, how about no, not today. And that's what the red lights all refer to here. So this is the price, and what this is saying is you get a red light if the price is down day over day or week over and week over week. So that is telling me that the market is not happy with day over day and not happy week over week. That's what we've got a red light here. And the RT is relative timing. And relative timing is saying, okay, from a direction, magnitude and dynamics point of view, no, not happy either here. Not happy at all. And then the BSR is the buy-sell ratio. People always tell me that I say that really nicely. Ratio. I think that's the way you say it. But anyway, other people say ratio, and I much prefer ratio. Buy-sell ratio is the number of buy recommendations in our database compared to sell. And right now, that is 0.49. And that is telling me that for every sell recommendation, right now in the VectorVest database, we have just half a buy recommendation. Or for every one buy recommendation that we have 2 sell recommendations. And that again is quite a bearish signal. So, also our MTI is at 0.83, like I've mentioned there. Our confirm call is down and the primary wave is down, right? It's all down. So what do we do about this? Okay, from an overall market point of view, I always feel that sometimes people feel that I have to do something, right? In order to take action in the market, I need to do something. But sometimes when it comes to the market, inaction is the action. And that's where I'm at, right? I am not somebody. Ratio. Kenny, no, ratio is just supposed to be ratio. So what I need, it's just important to make that point, is that for me personally, I'm waiting this one out. I am somebody, those of you who've been on the show a lot over the years, you'll know that I'm somebody that likes to sell options. Now, there's no point in me selling put options into this. There's no point, because I'll be losing out. If I sell options into this type of a market, okay, yes, we're into a lot of volatility, yes. On the other hand, though, is that clearly the market is bearish. There's a really significant bearish sentiment, and I would like to know when that turns around. When that turns around, we're in a different story. But at the moment, right now, it just feels like the sellers are pushing down. And you know what? If they're going to do that, go for it. By the way, I was one of them. I pretty much cleared out the portfolio last week. By the end of the week, everything was sold. And I'm very glad that I did, particularly before Friday. So therefore, I was one of those sellers pushing it down, and now I'm just waiting to be one of those buyers who's gonna, twirl it back up again. Right. Therefore, that is how we would handle the market, at the overall market at the moment. Now, what I'm going to do next is let's just go to another kernel, what underpins the market. Sorry. Also, what I want to do is, Cheryl says, consumers do spend during inflation. Oh, they do, Cheryl, yeah. Thinking that today's price will be lower than tomorrow until they don't. And you're right there, Cheryl. Yes, I mean, if I think today that, this laptop here in front of me is going to be $1,000 more expensive next year than this year, of course, I'm going to buy it now. A, assuming I have the money, and B, assuming that I really do believe that that's the case, and of course C, based on what we're seeing at the moment, is that it's actually there to be bought. But Cheryl, I'm doubtless, as you know, is that of course accentuates even further that inflationary cycle. And the same thing happens the other way around, guys. The same thing happens like for in deflationary environments. And unfortunately, having been in Ireland through an IMF bailout, when we did see deflation, we certainly saw deflation. What we saw there was that it was clear that prices were being cut because of course companies were trying in any way, shape or form to bring in revenue. Is then you say, well, sure, look, I'll wait for the sales because more sales are going to come, or there is going to be a better deal. So that's why having inflation at or below 2% really keeps that handleable. Okay, now what I'm going to do next is I'm going to talk to you about a real kernel of investing that I believe the tech capitals have lost sight of, and that is one of the things that I think that we can learn from them. And before I go there, Richard says, right now the market is bearish, so I sell deep, out of the money, short-term put options on the E-mini S&P. Premiums are high. I agree with you, Richard. Yep. Now, what Richard is saying is, let me just explain what Richard is saying. Right now, the market is bearish. That means that the market has a negative sentiment. If you're ever trying to remember what bull and bear stands for, bull fights with its horns upwards. A bear fights with its claws downwards. That's how you can remember the difference between the two. So, Richard said right now the market is bearish. He's correct. So I sell deep out of the money. So that means that if he's unlikely for these to be exercised because they're deep in the money, short-term put options. So that means that he is selling the right but not the obligation to sell, right? In other words, somebody else who wants to, the way I always explain this is, somebody else who wants to buy insurance on the S&P 500 can buy insurance for Richard. So he's receiving a premium to buy stocks, the S&P 500, in the future at a certain price at a certain date. And the more volatile that is at the moment, then the more money he's going to get. Again, he's correct. And he says premiums are high. Again, he's correct. The issue, Richard, that I would have, sorry, not the issue that I would have with that, go for it if that's what's working for you, absolutely, is that I believe the premiums can be higher as a result of a bearish market, and rather than selling right into that at the moment and giving up that premium, of course, at the risk then of giving up time value, is that it's a fine balance. So I just wanted to put that forward to you. But keep the conversation coming. It's good to hear what people are doing. Now, back to our tech capitals. Let me, I'm now just going to go back over here, and I just want to bring this up here, right? Because when we look back here at our big tech hubs, I also looked at, at other, so many different pieces that I read about this, like Atlanta, Austin, Dublin, of course, was in there as well. I found loads. I really and truly, I found loads. But one key consistent theme that I saw over and over again around a tech hub is VC, is venture capital, right? Is VC. Okay. Venture cap. Yeah. Okay. This is right. Indianapolis here is an example. In addition, more and more venture capital firms have established themselves in the state, right? This is over and over again. I'm seeing this. What I'm also seeing is government investment in infrastructure. Certainly that's helped us here in Dublin, for sure. A talent pool. Absolutely. They are really important, right? Having a talent pool is immensely important, and having a good, strong, connected ecosystem between education and industry, I think, yeah, for sure, that certainly helps. There's no doubt about it, nice places to live, like San Francisco, like Austin, Texas, like Dublin, if you want to include us in there, like Stockholm in Sweden, like Berlin, like Munich. Nice places to live, good, places that are vibrant and cultural, and a lot of amenities. Of course, they do attract people as well. And there's other kind of non-tech trends among all that, but this one came up again and again, and I think it's important that we just spend a little bit of time understanding what's going on with this world, with venture capital, because it connects and is absolutely influencing, in my opinion, absolutely influencing what's going on in the tech sector, in the public tech sector. And where I'm going to go is I'm just going to draw together the strands for you there, and where we're going to finish up then is over here with that kernel of investing that I want to bring you over here. So what I did was I created a watch list, okay? And I went in here and I just took the tech capitals, right? I took the big stocks out of the tech capitals. And they are the usual suspects in here, right? Google, Apple, Netflix, Microsoft, Meta, and Amazon. I took them all. These 6. These are the big ones that have had, right? That have had, look at this performance since the beginning of the year. Take this list on 3rd of January, okay? Top of the market here. And I'm just going to quick test them all, right? Look at that. You're looking at a 32% on average decline. Apple is only down 12. Netflix is down 61%. Netflix is down 61%. Meta is down 51%. Google is down 23%. Now, why? Why is it in an era where the S&P 500 is down 16%, on average, these stocks are down at least double? Why is it? Well, it's about what I'm about to explain to you. And that is why I really do want to make sure that I come back and I finish off on a kernel of investing that I think is so important, in many ways that I think many investors have lost sight of. I wrote my views on it this week. My views come out, it's in VectorVest Europe, they're out every week. and my views kind of, shaped this together. But I just think it's important that I just start off with the strands and I just weave it right back to this point. Okay. These tech capitals, where a lot of those companies have come out of, definitely have a really big venture capital ecosystem, right? Of that, I think we can all agree. But if you look at what's going on over here, Venture Capital Silent Crash, where the tech boom met reality. This was published in July, if I'm correct. 1st of August. Okay, 1st of August, a month ago. And I found this piece down here. When you look at the amount of money being put into startups, right, it skyrocketed in 2021. This is annual VC investment deal making. Went dramatically up, right? Dramatically. And some examples, right? Some examples are given down here. We've Klarna, we've Cruise, we've Rivian, we've Robinhood, right? Now that's serious money. Like, Rivian to have actually gotten over $5 billion, like $5 billion, like into one company. That's a lot of money, right? That is a lot of money, but the money was there. And I've always been intrigued. I am somebody that I'm an entrepreneur through and through and through. And I love the fact that a company like VectorVest enables somebody like me to be entrepreneurial and to bring new ideas to the table and to make things happen. So I am always appreciative of entrepreneurial ambition and intent. But what has intrigued me is that as a child growing up in rural Ireland, I always thought a company had to be profitable, full stop. And secondly, profitable with a view to growing. Now, I understand short-term pain for long-term gain, but, I always thought, like, look at Microsoft. Like, if you look at Microsoft across the 90s, it was a profitable company selling things that people wanted at a price that was higher than what Microsoft had to pay in order to buy them. But then over the last 15, 20 years, that changed. I felt it changed. Is that we saw companies like Uber that actually, the more they grew, the more money they lost. Like, we saw companies where they're getting massive valuations in the stock market, not because of the revenue that they had. Never mind profit, not because of the revenue they had, but because of their user growth. Like, take a look at WhatsApp. Now, WhatsApp is a company that Facebook, now Meta, spent $22 billion on. It didn't make money. Now, by the way, it has also, they spent $1 billion on Instagram, if I'm correct. They spent $1 billion on Instagram. And from what I understand, now let me just check this. I'm pretty sure that has turned into, it's now worth $20 billion. Okay, so Meta, Instagram, $1 billion ROI. I'm pretty sure I saw this somewhere just the other day. Okay, let me just down here. What's my earnings call? Find Instagram. Just trying to find this on this fly, Daily users. Okay, I won't spend any more time on it, but it certainly has worked out for them. Instagram has certainly worked out for them, and I thought I saw that the billion had turned into a $20 billion worth. That is what it's now worth to them. So I get it, right? I do get it that spending money on something where you can subsequently monetize that business definitely makes sense. But that hasn't always been the case, and therefore, if you read through this now, it's quite a long piece. But when you read through this, there's a couple of things that really come out of this. And number one is, like, what happens when you've got companies that are really, really high, right? That have got really high valuations. What happens? Well, first of all, it can keep going. So the scale of the most recent venture boom has dwarfed that of the end of the 90s, when annual investment peaked at $100 billion in the US. In comparison, the amount of cash pumped into American tech startups last year reached $330 billion. So obviously that is, immeasurably, not immeasurably, it's very easy to measure, much more. Okay, but also is that we're now seeing that, according to Code 2, one of the new band of crossover investors has moved into the public markets, and $1.4 trillion found its way into promising growth markets last year. Now, the UK economy, and am I right, Dinesh? Dinesh is there. The UK economy is worth $3 billion. So half of the UK economy equivalent found its way into promising growth companies last year. Half of it in the form of VC, half of it through IPOs. That's a lot of money. That's a lot of money. So obviously it can't keep going, right? And then of course, yes, you have the fear of missing out, etc. But I also wanted to bring this one up here now, right? Let me just put when it peaks and when it falls, like, just let's actually think about what this means. over here it is. It's laid out here for you. Is the Americas region in Q2 2022 saw a decline of 73% in the number of deals, 95% in the proceeds. So Asia Pacific recorded 181 IPOs, decline of 37% for volume and 42% in proceeds. And then EMEA had 83 deals, a decline of 62% in terms of volume and 44% in terms of proceeds. Like that's pretty significant. So what does this mean though? Well, it means a couple of things. It means that it's now, okay, it's not going to be as easy to get money, perhaps. But let's really think through the impact of that thereafter. What exactly has this money been chasing? Well, it's been chasing big tech ideas, like self-driving cars, like Cruise, like maybe moonshot ideas that are, take a long time to turn into money, revenue, and certainly profit, but maybe have a long lead-in time from a timing point of view and need a lot of capital in order to make things happen. Is that if actually the excitement is worn off that, or maybe the cash flow isn't coming through, the growth isn't coming through, what happens then? Well, then of course this is what you get. And I think that this is a quote that I put into my views this very week. This one here is: given the tightened market liquidity and significant decline in stock prices of many new economy companies that went public during the last 2 years, investors are becoming more selective and are refocusing on the company's fundamentals instead of just growth stories and projections like sustainable profits and free cash flows. Now, therefore, let me now bring you right back to the VectorVest system and let me show you the problem and what to do about it. If I now go back to the system and let me take these companies here, right? I'm going to go back to today. And what I'm going to do for you now is I'm going to go back to that kernel of investing that I have been talking about since the beginning. Okay. Run that. I'm just going to update my watch list here. Right. And that is that there's only two reasons the stock will ever go up in price. Only ever two reasons. Number one is if the earnings are growing. And number two is if the PE ratio is growing. If the amount that investors are willing to pay for that dollar or euro or pound of earnings is growing. Otherwise, no, doesn't go. So let's just put our tech stocks to the test then. I'm going to go in here into Unisearch. And I am going to look through my watch list, and I could put in any stock you want, any tech stock you want in there. And what I'm going to do is that I just want to look into my watch list now. Okay, here it is. Here's my watch list. And okay. And I want to see stocks that are growing. GRT is growing. GRT. I want the growth rate of my earnings to be increasing. Okay, is trending higher over 5 weeks. And I also want to see that my PE ratio is trending higher as well. PE ratio. PE ratio. PE ratio. PE ratio is trending higher as well over the 5 weeks. And let me run my search. And the answer is no stocks. There is your answer. This is why it's happening. Is because, yes, we have got a bearish market sentiment, and we've discussed that at length. And how we look out for where that turns is if we can start seeing yellow and green lights in the colour guard, when we see the MTI going over 1, when we see the confirm call going green. That is what we want to be looking out from a market point of view. But from a sector point of view, as you can see here, the growth rate of the earnings is falling, and also the shine has gone off them on the part of the investors. And this is tying back to that venture capital, that hunger for venture capital, and all of the things that is happening there. So, what can we do about it? Well, let's go back to that statement. Is that this statement back here, which is investors are refocusing on company fundamentals instead of just growth stories and projections, like sustainable profits and free cash flows. Right. So how do we get that? How do we get sustainable profits and free cash flows? Okay, well, let's go and make it happen then. What I'm now going to do is I'm going to take off this stock watch list. Let me just take it away, right? And now let's run the search. Have we got any stocks at all in the US market where we can see the growth rate is higher over the past 5 weeks, the PE ratio is higher? Okay, well, we can see one stock, right? We can see one stock. Now, rather than me being as specific as the last 5 weeks, here's a little trick for you in the VectorVest system. How about this? Is that we say that the 2 weeks ago, no, 10 weeks ago, the growth rate was less than 10%. And today, I'm just going to delete this parameter. Today, okay, we want the growth rate to be above 10. That's another way we can do this. GRT above 10. Run the search. Haha! Here we go. Here we go. Now we might be looking. This now might give us something else to work with. Right. Also, what else do we want? What we also want is we want relative value, which is price appreciation potential. We want relative value, RV, to be above 1. Okay, let's run that search. Good, okay. Now, let's keep going. Now what I want to see is at a minimum, I want to see a company that's profitable. So now I'm going to go over here and I'm going to look at EPS above 0. I'm going to run that search. So I want to see at least that the earnings per share is positive. Okay, now you can see I'm getting the same ones here over and over. One last thing. I now want to see that this RS, right, the relative safety, is above 1. So this means that the consistency and predictability of financial performance, which is, to go back here, of my financial performance, which are dividends and earnings and various other metrics like that, are above 1. And let's run that search. Right, okay. Here now, what we've got now is we've got a range of stocks now that we might look for. Okay, I don't want a sell recommendation. So I do not want REC. I do not want REC equal to sell, right? I do not want to see that. Okay, now run the search again. Here we are. This is now here. I've got my refined now list of stocks, and this is what, to take that statement from that press release around valuations, this is what investors are looking for. We're looking for stocks that we can see are growing their earnings. We're looking for stocks where we can see that it's got fundamentals that are strong, like long-term price appreciation potential, consistency and predictability of financial performance. We're looking for profitable companies. Here we go. That's how I found them. That is how I found what investors are looking for. Now, before we go any further though, I want to see them all. I always like to see stocks before, going any further. Right, what have we got going on here? Now you can see here, look, see the earnings are rising, and we can also see that the PE ratio is rising. Now I just need to check my phone screen here. Can you see that? Okay. All right. Maybe it might be easier on you if I just make. The reason I have the phone here is so that I can see what you can see. All right. Now that's better. Okay. And now look here at the RT. Look at the RT, right? So the relative timing here is also improving. Now slackening off a little bit, all right, here over the last couple of days. But in this case here, I can see that the RT, which is direction, magnitude, and dynamics of the share price, is also has been improving in contrast, for example, to the market over the past while. So that's one that I can see. Okay, no, I don't like this. The reason I don't like this is because it is extremely limited volume, and I can tell that by a choppy graph. I'll tell you how I can get rid of the like of that happening. Is I now also want to put in volume, average volume, and I want this to be above 100,000 shares per day. 100, 1000. Okay, now let's run the search. That'll probably deal with that. All right. In fact, now I'm down to 3. Okay, all the better. So I'm now going to graph these. I've already been through the first one. Okay, let's take a look now at the second one. Okay, pretty similar story. Rocky enough earnings now. Rocky enough earnings, but up, down, and then up again. Again, I can see overall, I can see that the RT is rising, and I can also see that really the PE here, when I look at the PE here at the beginning of this period, the PE was at 19.99. Now it's at 21.23. So it went up and it's come down, but is higher a little bit there on average. And this one's PE. Now, this is a lovely looking earnings graph. But what is not so good here is the PE ratio is going down. It's telling me now that investors are losing faith in the stock. Started to change there. Generally happens all right after a good run at something like this. But here's an issue in the RT. The RT would have taken me out there. So as you can see, it's not necessarily easy finding stocks that have got the favour of investors in this type of a market. But ultimately, this is how we do it. And what I wanted to do today, which is very different to what I had actually intended to do today. I'm just going to go back here. What I wanted to do today is I was going to take you on a whistle-stop geographical tour of the tech capitals of the world, and I was going to take a look at the stocks in them. But you know what? That was just going to wield pretty tricky results, because the problem is that the tech sector is not feeling the lurve at the moment at all. So, in essence, what I wanted to do to bring everything together was, first of all, to start off, we needed to talk about the market, and we needed to talk about what's going on in the market ultimately that is leading to that confirmed down call last week, that has got the MTI down to 0.83, etc. And that's why we had to focus on inflation, earnings, and I wanted to really get an understanding, or to give you a sense of why the market is worried, why the central bank is doing what it's doing, and how, I've never lived through a time when the central bank was so divorced. I suppose that's not really the word. The central bank was so limited in its ability to affect the key root economic issue, which is in this case inflation, of which its job is so directly related. And then from there, what I want to do is just to actually really look through the tech capitals of the world and to say what is it that they do share in terms of their commonality. And one of them is the VC infrastructure, the government infrastructure, the talent pool, nice place to live. And then, of course, success begets success, which is that when, like in Dublin, we have the headquarters of Microsoft, we have the headquarters of Meta, we have the headquarters of Amazon, I believe, we have the headquarters of eBay, we have Twitter. They're all here. And there's a really good cluster of companies like that in Dublin. Similarly, everyone I've just mentioned to you probably has a big office as well in San Francisco and so on. So, but the one key thing that stood out there for me then was that VC infrastructure. And when we look at that VC infrastructure, I needed to look at what was going on there, because that holds the clue. That holds the clue is that when you have massively high valuations, number one, they have to fall sometime. 2022 is that year. Number two is, what is the overall implication of that? Is that ideas like big, capital intensive, unprofitable for a period of time ideas, then questions start being raised about them. Then when we look at that, then we have to say, okay, well, how is this translating into the public markets? And of course, we're back to that kernel of investing, which is there's only two reasons the stock market will grow in any stock, because the earnings go up or the price of the earnings go up. And as you can see, when I looked at technology, the big ones that I showed you, all of which have lost money this year, at least on average double what the market, the S&P 500 have lost this year. We need to understand why. And it's because the earnings growth rate is falling. Not necessarily the earnings, some of them, but not necessarily the earnings, but the earnings growth rate. And of course then that also ties in then with the price of those earnings as well. So flip that on its head, and then we'll say from that EY statement, how then can we find those stocks? Like what are investors willing to back, assuming that we're in a bullish again environment? Well, they're looking for fundamentals now. So how do we find fundamentals? Well, then we build them into a search and we take it from there. And just coming up right on time today, I'm going to say thank you so much indeed to each and every one of you for being here with me. I thoroughly enjoyed the show today. I always love your interactions though. Like, I love those comments coming. And if you are watching this one, I'm not live, please do put your comments into the chat. We're only delighted to see that. I'm going to be back to you again in a month's time with another episode of the ESG and Tech Show, and also we have got some new content coming your way as well that I'm going to be involved in, and I'm going to tell you all about that when the time comes. But for now, thank you all for being here. Please do, of course, make sure and join our mailing list, vectorvest.com/FFF, and then you will be notified of upcoming episodes. And of course, if you can, please do share this episode, use the share button, send it into your WhatsApp groups, send it on to your friends and invite people to subscribe to the channel so that when it's me, or whether it's Glenn or Patrick or anybody else, when anybody else is going live, then you know about it. Thank you everyone, and goodbye.